Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Brett Swartz. Brett is considered one of the most well-rounded capital gains tax deferral experts and informative speakers on the West Coast. His audiences are challenged to create and develop a tax-deferred transformational exit wealth plan using the Deferred Sales Trust, DST, so they can create and preserve more wealth. Brett is the founder of the Capital Gains Tax Solutions and the host of the Capital Gains Tax Solutions podcast. Each year, he equips hundreds of high net worth business professionals with the DST tool to help their high net worth clients solve capital gains tax deferral limitations. And in just a minute, we're going to speak with Brett about Deferred Sales Trust. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Brett. Welcome to CRE PN Radio.
Darren, thank you for having me. I'm excited to be here.
I'm looking forward to our conversation today. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Absolutely. Thanks, Darren. So I'm originally from Northern California, kind of Mission, San Jose, Fremont area, and the Sacramento region. And I grew up in the real estate world. My dad building custom homes, my mom owning rentals. So I've always had a love for investment real estate. I continued that love into college, where I took an internship at a company called Marcus and Millichap, and it was there that I cut my teeth and learned all about how to underwrite a property, how to sell a property, how to negotiate, how to get financing on properties, and mostly multifamily was my specialty. But it wasn't always easy, you know. Growing up, my mom and dad had a lot of wealth. Then they got divorced, and they went from, having, let's say, a lot of money to no money almost overnight, because let's just say my dad didn't pay as much child support as he could have, right, over the years. And so I struggled financially, right, with my mindset, knowing that at some point I don't want to have to depend on a job or a person. I want to be able to own cash flow producing real estate and have that, be able to build that amount of wealth. And so brokerage is a way to learn from the best, from my clients, hear their stories, solve their problems, earn enough so that we can get on what's called the other side of the phone. And so that's where I started out, cold calling, and learning the business. But it was 2006. This was an interesting time when the marketplace was very high, very hot. And it went from a very high market, people making a lot of money, to the 2008 crash, where I was making a little bit of money, and then overnight, nothing. And like a lot of commercial real estate brokers or owners during that time period, we had to figure out something else, right? And my something else happened to be, at the time, my wife and I were barely married, and then baby on the way. And the answer was moving in with my brother to a small condo to cut expenses and getting a side job at a place called Cheesecake Factory. So by day, I'd make cold calls, helping clients kind of combat the banks and try to get creative ways to rent their units out and renegotiate their taxes with the city. And by night, I served cheesecake, and I did that for a 2-year period. And during that challenging time, I don't know if you've ever been so scared, Darren, you're not sure what you're going to do, or that's where I was at. Like, I didn't know what I was going to do. I felt like a failure. All of the fears of my parents' divorce and the financial things kind of kept coming up, but I just kept persevering. My wife believed in what we were doing to build wealth and the plan. And I loved commercial real estate. That's the one thing I knew. And I had amazing mentors who believed in me. So I kept pushing. And during this time, a gentleman came in and he spoke about the thing called a deferred sales trust, which we're going to talk about. And it was one of those moments that everything kind of changes, but it didn't change right away. I started to talk about this. I started to try to educate people. And for those who don't know what this is, we'll talk about it in a minute. But we thought we knew everything, Darren. Like we thought we were the Navy SEALs of investment real estate brokerage, the 1031 exchange, the tax deferral. We're going to help people do all these things, but we didn't know it all, right? And that's what I found out at that day. But what went on to happen was I started to apply this strategy, talk about it. My business started to grow. Fast forward, I retired for the Cheesecake Factory. My wife and I have 5 kids, and she's been able to stay home full time, which is one of our values for our kids and for her and for our marriage. And I'm here in Sacramento, and now I teach and train people how to do this.
Wow. Well, that's congratulations on your 5 kids and your family, and getting or the commitment to see it through and to work hard and make it work. That's impressive. So
Thanks.
let's start with just the you mentioned the concept of a 1031 exchange. I think most people are familiar with the words, maybe familiar with a little bit of the dates that might be in play, but not always all the nuts and bolts. And I'm wondering if maybe that's not a place to start, because if I understand right, that's kind of the trigger for working with a deferred sales trust.
Yeah, you got it. It's a great place to context, because a deferred sales trust is kind of like a 1031 exchange. It's kind of like an IRA. It's kind of like a 401k. It's kind of like a lot of things. And we like to call it the Netflix way of doing things versus the old Blockbuster transactional way of doing things. So let's define a 1031 exchange and why it's like Blockbuster. Well, do you remember going to Blockbuster on a random Friday night, Darren, maybe 10 years ago when they were still around, and you see that movie behind that cardboard and you're walking up to get that movie, but for some reason, someone's 2 steps ahead of you and you're like, man, I missed it. Now it's sold out, and you're bummed out. But you get that second movie and you take it home, but within 3 days, you forget to return it, and then you got a penalty. And then you forgot to rewind it and you got a penalty. And then you had to drive your car back and forth and sit in traffic. Well, that is the old way of doing things. That's the 1031 exchange. And what we found out while I was going through all those struggles financially and working at Cheesecake Factory, my clients were going against the banks, right? And the number one cause was they had overpaid for property, and they had too much debt, not enough liquidity, and they let the tax tail wag the investment dog. Right. And they knew they were doing it, but they felt trapped because of the 30 to 50% in capital gains tax and depreciation recapture, right? And the 04, 05, 06, 07 market before everything kind of turned. So they knew they were making poor decisions, but they felt they had no other way to get out except for just doing the 1031 and just buying and hoping and praying that the values would hold up. Well, that was the kind of ground zero of why we found out that 1031 is Blockbuster, because our parents taught us to sell high and buy low, not sell high and buy higher 180 days later with little to no inventory, little to no value add opportunity, and in more debt, right? And unfortunately, the 1031 exchange just does not work in every situation, right? There's different tools for different periods of life, financially or personally. And with the 1031 exchange, a lot of our clients, they're baby boomers, right? They're in their 60s. Or older, and they're looking at this and they're going, I've made my wealth. Why do I need to take on all this debt? New rent laws, new rent control, new toilets, trash liability. I don't need all of this stress in my life. I want to retire from this, but I also want to be able to pay off debt and get diversification. So an interesting study, according to the American Bankers Association, there's about $17 to $20 trillion that's going to pass from one generation to the next in the next 20 years. And this is known as the largest wealth transfer in the history of the planet. In fact, there's about 77 million baby boomers turning 65 every day. 77 million baby boomers in the U.S. alone, and about 10,000 turning 65 every day. And they're faced with toilets, trash liability in large primary homes, investment properties, stock, other assets that are highly appreciated, cryptocurrency. And they're looking at huge tax, and they don't know how to get out. And again, the 1031 exchange is like Blockbuster because it only works for investment property. We just closed a property in Palo Alto for a primary home seller who wanted to downsize from his house. He had 5 kids. They're all gone. And he's like, I just want to retire, right? I want to downsize. Kids are all gone. I'm in this big house. Doesn't qualify for a 1031, but he used that. So the 1031 only works for investment property, doesn't work for primary, doesn't work for stock, doesn't work for other things. But the biggest thing is time, because it forces you to make quick decisions. Whereas the Netflix version, the Deferred Sales Trust, you can now sell high and defer the tax on the sidelines for as long as you want. And there was a story that kind of changed it for me. It was a gentleman who sold a $20 million asset in 2006. And he sold at the height of the market, and he looked around for a 1031, couldn't find it, used the Deferred Sales Trust for the first time, and he parked the money. Where? Stocks, bonds, mutual funds, conservative stuff, right? He's not a big stock market person, but it was better than paying the tax. And he sat on the sidelines, and 5 years later, that property that he had bought was foreclosed on. And the bank calls him back and says, hey, you know that property you sold? He says, yeah. Well, we just foreclosed on it, and we're just curious, would you want to buy it back? And he's like, well, maybe. What's the price? And he said, well, about 40% less than what you sold it for. He said, sure. So he was able to reallocate the investments in the Deferred Sales Trust, and he's able to buy that property back at 60 cents on the dollar, okay? All tax deferred. And so when I heard that story and understood the power of that, it changed everything. So that would be the first thing. It's a way to get time back, to diversify, to get liquidity, and to wait for a deal to hit you over the head versus overpaying for a property that you know probably doesn't make much sense right now.
No, that's pretty powerful because, like you said, the 1031 exchange and the dates, and especially if you're in a hot market, it's one thing to be the seller, but if you're trying to buy something and everybody's chasing the market up, um, you're faced with that situation where hopefully you don't overpay, and that you've got enough time that if need be, you can weather the storm or get out. Um, so you said something that made sense to me, because I think the other thing is that the part of the 1031 exchange is that you replace the equity and the debt. So if you leveraged into a property originally at say 20% equity and 80% debt, and it appreciated, now you're maybe in a 50-50 if you're lucky, kind of thing. You still have to replace that debt that you acquired, which basically requires that you go to a larger, more expensive property in order to successfully do a 1031 exchange. And like you said, just the stress and if you're older and you're wanting to get out of that, something that's a little bit less stressful and a little bit less risky is probably a good idea.
100%.
And so the you introduced the topic, the deferred sales trust. So let's talk about those proceeds from the sale of the property. How is it that the mechanics of this, that you have the property, you sold it, you were seeking to do a 1031 exchange, but now you've decided, now maybe I won't do a 1031 exchange. I'm going to do a deferred sales trust.
Yeah, first of all, understand it's not a 1031. It's not a Delaware statutory trust. Don't get these two confused because DSTs often get confused. The key thing, the foundational understanding of how this works is IRC 453, which is known as an installment sale or a seller carryback. So as the client, if you're selling the deal, Darren, you're going to lend the funds to the trust in exchange for a promissory note. You're typically going to take 100% financing, back. You're going to take all. You're not going to give any down payment from the trust. You're going to give all the financing to the trust. And when you do it like that, you haven't received any cash payment. Therefore, you're in a tax deferral state. Then we find the third party buyer, and that buyer actually buys it from the trust and infuses the cash into the trust. And the trust buys and sells for the same price. Therefore, there's no tax at the trust level. And since you sold it and you received no down payment, you're in a deferral state. It's not unlike an IRA or even a 1031 if you think about it, right? Think about how a 1031 works. If you sell a property, let's say for $10 million, you have zero basis, and all the funds go to the qualified intermediary instead of going to you, well, you haven't received any of the funds yet. They're at the qualified intermediary. Or even like an IRA works, that way the IRA works is the government says, look, if you put money into this IRA, as long as you don't touch it or take distributions, it's in a tax deferral state. It's building and growing. So same thing with the trust. We form a trust. The difference is you don't own the trust, you lend to the trust, and then the trust will slowly pay you over time in installments, and you'll pay the tax. So we just closed a deal in Alabama, it's a $2.6 million business sale, and he owed about $600,000 of tax. Again, didn't qualify for a 1031, but he's a business. It did qualify for the Deferred Sales Trust, so he moved it into the Deferred Sales Trust, sold it to the ultimate cash buyer, which was his partners that bought him out. And then he is building 70 units in Tennessee right now, all tax deferred ground up development. So it's a really nice way to go on to that next thing The key is, as long as it's in an investments and as long as it's out there, it's in a tax deferral state until when? Until the income starts producing on the trust and you start receiving payments. Well, when do you receive payments? Well, some of them receive it right away. Some clients, we just did a deal, a $1.4 million primary home sale for a retired teacher, and she was on a fixed income. She lived in the house for 25 years, and she's able to sell her house that she bought for about $200,000 for about 1.4 and defer all the capital gains tax. And now she's going to live off the interest payments of the trust over the next 10, 20, 30, 40 years, pass it to her children who can continue it on as well. And so it becomes a nice vehicle to not only defer tax, but to live off the cash flow.
Got it. So I understand the transfer of the asset into the trust. Is that right? And
You're
then the
selling
trust
it to the trust.
Oh, so you're selling it. Okay, you're selling it to the trust.
Yeah.
The trust then makes the sale to
The ultimate buyer, a cash
ultimate buyer.
Yeah.
The proceeds then of the sale go into the trust from
Correct.
the buyer to because the trust is now the seller, right?
Correct.
You mentioned the individual that either the one that bought back the property at a 40% discount or the other one that's building some apartments or whatever.
Mm-hmm.
I'm assuming that the money within that trust, in order to do the investment, does it come out of the trust, or can you grow the trust by doing that acquisition or that build within the trust, where it's just the assets of the trust continue to grow?
Yeah, so it's the latter. So you can do both. You can take a distribution and pay the tax and go do it by yourself, or you can partner with the trust. See, the trust needs to make a return, typically about 8% over 10 years, and the investment allocation can be a number of things: stocks, bonds, mutual funds, hard money lending, or real estate, passive or active. And so we do that in a way that allows them to do both. By partnering with the trust to go do that, all tax deferred, by the way, right? So that's where most of our clients like to do. Just keep it growing, keep it earning, keep living off the interest.
So in so you fund that, you continue to grow it, you take your distributions. You've talked about like different timelines. Is there any limitation on the length of time that the trust? I mean, is the trust? I mean, I've always thought of the purpose of an estate trust was that the trust doesn't die, which doesn't trigger the tax being due. Therefore, it continue the assets continue to be held as opposed to having to be liquidated. Is
So
that
no timing restrictions. So typically they're 10-year terms, and every 10 years you can renew for 10 years, renew, pass it to your kids via your living trust. What you own is the promissory note, right? That's what you own. That's what's inside of your living trust. Okay, and then the kids can step in and start receiving payments from the trust as well.
okay? And is it typical that the uh, the 10-year term is designed to draw down the amount of the asset or amount of the sale or whatever to a zero, to where you're basically just paying 1/10 of the tax annually?
Yeah, so we can structure the payments back in principal and interest, or just interest only payments. Many of our clients like the interest only portion. They like to keep the golden goose intact and let the golden goose lay the golden eggs, right? And just live off the interest. And so, but it could be structured, yeah, 1/10 of it over 10 years, or just interest payments and just renew it. It's up to you. And it's adjustable too. You might adjust it along the way. You might say, hey, you know what? I started out thinking I needed this, but maybe need that. Can we adjust it? Yeah, it's amendable. You can amend the promissory note, and upon amendment, we can have it accelerate payments or decelerate payments. It's flexible.
Got it. So when you fund the trust, uh, who is in charge of making the investments, or I mean, is this like a self-directed IRA, or does there need to be an intermediary
Mm-hmm.
that's handling this, or?
Yeah, let's talk about how and where the funds are invested and how it's determined. So before the funds go anywhere, as if you're the client, the note holder, the taxpayer, you're filling out a risk tolerance questionnaire. Okay, and if you're married, so is your spouse. It's a 2-page questionnaire, no wrong answers. It just tells about your level of risk, your income needs, and based upon that, you get a score. Based upon that score, an interest rate is assigned. Based upon that interest rate, investments are presented to you, right? So you have all the approval. The funds never go anywhere without your full approval, and no investments are ever made without your approval. Now, it also takes a second approval, which is this is part of my role. I'm the trustee. I'm a third party, unrelated trustee. Very important. Not related to the taxpayer, right? And by having that separation, it takes dual approval for any investments and dual approval for any of the funds to move, and that keeps the protection and the integrity of the tax deferral. If there wasn't that second approval, it would be taxable, right? Because you'd just be selling it to yourself, or you'd have what's called unilateral control. And when you have unilateral control, it's just taxable. So it's a business entity that is set up to do just business with you, and so it's we're all working as a team. Now, we want what you want, right? And so the goal is, what kind of risk would you like? Where would you like to put the investments? Where would you invest it anyways? And let's try to mirror that, but it's all based upon the risk tolerance, and it's all mathematical. Does that make sense, Darren?
Yeah, I think so. I mean, the third party, I mean, you've got to be the one there's got to be somebody in there that's approving, and I'm assuming that's per the design or the statute or whatever that keeps
Yes,
the integrity of it.
exactly.
So, okay. And then within that vehicle, are you limited to the types of assets? I mean, 1031 typically is associated with real estate, but can you go buy stocks, bonds, Bitcoin, um,
The
any and
latter,
all of the
right?
above?
So
Okay.
the investments can be secured against a number of assets, right? And so
Okay.
um, the return for the trust to pay back the interest can be secured against a number of assets, including liquid, diversified investment grade securities, insurance products, mutual funds, right? Hard money lending, uh, passive real estate, active real estate. As long businesses, as long as it's business purpose, right? Economic substance, right? These are the key terms here, right? That it's for the greater good. And then this is why we believe the IRS really likes what we do. And it's a good thing everyone wins, because it's stimulating people to sell assets at high prices and infuse the money into the economy, which does what? It creates more jobs and more tax revenue, which creates more taxes. It also gets a new property tax, right? So for the property we just did in Southern California, she bought it for $200,000. Well, guess what? Her property taxes are pretty low, right? Well, she's selling for 1.4 to a new buyer. Guess what? New property taxes. Guess what? That listing agent gets a commission. They pay taxes, right? Escrow, they pay taxes. All of that money goes into stocks, bonds, mutual funds, or real estate, which does what? Creates more jobs. We're doing an Ethereum case right now. It's a Bitcoin case, and cryptocurrency case. They bought Ethereum for about $100,000, and it's increased in value to like 6 million in 2017, and then it increased in value to like 12.5 million here recently, right? And they're going to sell it, and they're going to defer the tax. And it's not just the numbers, it's the transformation for them. They're able to retire from working 50, 60-hour weeks. They have young kids. They want to travel the world. He's from another country, right? A lot of different things there that enable them to do a lot of things, because the Deferred Sales Trust is doing what? It's going to defer about 4 to 5 million of tax. It's going to extend the amount of time and the amount of money they can live off of by a really, really, really wide margin.
Yeah. No, that to me, I was just having this conversation with my mother here the other day about, the concept of a 401k as opposed to an investment, and it's like I always thought that the plan was to have enough assets to live off the interest, or, that the investment would continue to grow, which I think is possible in real estate, at least to, create a sizable amount of equity and live off the returns on that. But I think most people are that's maybe a thought, but it's not really reality when you get into like a 401k, where you basically have to liquidate your asset in order to abide by the tax laws and just to live, kind of thing. But in this situation, what I like what you're talking about is the ability to you know, sell at a high price, keep the asset, or the value of the asset working for you, pay the tax that's owed as you spend or receive the proceeds, but not like in a big lump sum. So you can do a little bit of tax planning if you need to be or need to. But let me ask you. You mentioned we talked briefly about it, but the upon death, heirs, the transfer of that, the trust being a trust, I'm assuming that can continue, and it's not there's not a need to liquidate it to satisfy any kind of a tax law. Is that correct?
Yeah, that's a good point, right? So Biden's proposing some big changes, right? One of them is the elimination of the stepped up basis. Okay, I don't know the odds of that going through. Maybe you're low, but it could. But imagine that you own all of this piece of real estate or assets. You're in the ownership side of things, and you thought you're going to get the stepped up basis, but that's no longer happening. And now the tax is triggered upon death. This is part of the proposal. The kids would have to liquidate to pay that tax. Okay. On our side, remember, you're not an owner, right? You're a lender. So you've lent the funds to the trust, and the trust bought and sold for the same price, so it has no gain, right? And so upon the sale, upon the close, or upon you passing, the promissory note passes to your kids, and your kids can just step into your shoes and keep this thing going. So we solve that challenge there on the stepped up basis, and they can keep it going for as long as they want. And as they receive cash payments, they'll pay tax. But they could also pass it on to their kids. They just keep it going.
Right. No, I was thinking about that in preparation for this, that this may be a real, if the tax winds change as there's a lot of talk and a lot of effort invested in the talk, but I don't know that there's actually the will to totally change the tax laws. But even in that era of a change, the fear can drive the market to do certain things. And I was thinking, like, just to if you think you're going to reap a benefit by in enacting a law, what you're failing to recognize, at least what I've seen, and I think what most investors will look for, is the alternative that continues to allow them to uh, have the benefit that they originally sought for the investment that they got in. Like, so real estate, if you got in real estate and were expecting to be able to pass on um, your your assets to your heirs at a stepped up basis, this seems like this would be an ultimate defense mechanism to avoid the potential of a law change that would potentially liquidate uh, the assets that you've worked so hard to grow.
100%. We think we're really positioned perfectly for what's called the three perfect storms, right? The demographic baby boomer, largest wealth transfer in history of the planet happening, the economic, highly appreciated assets that could be subject to a big correction, and the third one being the political, 20% to 40% on the capital gains tax rate, elimination or reduction of the 1031 exchange, elimination of the stepped up basis. We literally, every one of those boxes we check off, and we're a great alternative. The other one is the estate tax, right? So there's some people listening, perhaps they have a huge estate, and they're looking for ways to move funds outside of their taxable estate. The Deferred Sales Trust can also do that too. We have a proprietary version of it where no matter what the size, we can move funds outside of the taxable estate. And that's a nice way to save on 40% of that. So you can learn more about that. The other one is income tax deferral. So remember, you can delay the payments of the trust, which could also lower your overall income tax in that given year. Now, when you receive payments later, then you'll pay tax, right? But that's a nice piece of this. And the other one's a brand new depreciation schedule. By partnering with the trust, you can get a brand new depreciation schedule. And then as you roll payments out, some of it can wash out in the given year. So lots of ways to make this an investment, right? And a really a good solution for that transformation when you add them all together.
Right. So I think if I understand something that I hadn't really recognized in the past conversations I've had about the deferred sales trust, is the vehicle is this note. Basically, that's that's really the way that you're getting the income. I mean, the assets in there, but whether it be like the interest only payments, which I would assume that if people have a large enough nest egg, that would be kind of the preferred way is to try and find something where they can receive interest only. Is that, am I tracking on that?
Yeah. So if you're passive, that's exactly right. It's just, if I'm like 100% passive, it's just in real estate or it's in passive real estate. It's in stocks, bonds, mutual funds, hard money lending, and it's just producing, interest, and you're living off the interest. However, the really place where this thing really flies is when you partner with the trust and you become active. Okay, so back to the scenario of my client in Alabama, right? He's actively building those apartment complexes, right? So in partnership with the trust, think of the trust, it can be like a silent partner with you, and you can build or buy real estate. And then you get ownership in that LLC that bought that real estate in partnership with the trust, and then that's where you get some new depreciation, okay? So it's a really nice, elegant way to build wealth on the ownership side again, right? With the trust that you lent money to. Okay. And so that's without that, then this is like just not as exciting. But with that, it's absolutely a game changer.
Yeah, that's huge. So, in that example where you're partnering with the trust to go out and build some property or build a property, and you see it to its conclusion, and it cycles from construction to
Mm-hmm.
operation to sale.
Mm-hmm.
The proceeds from that sale, can you then uh, sell to the same trust?
Yes.
Okay, and then so essentially you keep growing that trust as the
Rinse, wash,
okay.
and repeat, right? So
I love that. That's
buy
great.
low, sell high, invest where
That's
it makes sense, build where it makes sense, sell, roll it back in, wait, be patient, dollar cost average back in. No, we're a safe harbor, right? Park your funds, pay off your debt. So we're telling a lot of our clients, sell high, pay off your debt, defer your tax, dollar cost average, diversify your investments, right? And then just wait for a deal to hit you over the head. And it might be a development deal, or it might be a real estate deal that someone gets foreclosed on in a year or two or something, right? But don't do the blockbuster, right? I saw the blood in the streets in '08 in the crash, right? It was really sad to see people lose half or lose all of their wealth because they just wanted to they only knew. They didn't know. It wasn't their fault. Their CPA didn't know about it. The 1031 exchange companies don't want you to know about it. Most commercial real estate brokers companies don't want you to know about this. They're in the business of keeping you in the 1031 race. And it's a race for how big are their commissions and how many deals they can do. By the way, I get it. I'm a commercial real estate broker, and I started at Marcus & Millichap, and that's the mantra, right? And they're a great company. They do a really amazing stuff. Nothing wrong with the 1031, but guess who's really on hook for that deal if you overpay? It's you, right? So in this scenario, we don't want you to feel trapped. We don't want you to feel like you have to do anything. We want you to have freedom.
So let me ask you, the investment, some of the rules of investing or kind of, I guess, the tax issues you have. I know that like with people with, if they're using their 401k, there are some rules that they can't, engage in. One is lending to a family member, whether it be a parent or child or kind of thing. Another is unrelated debt income. I think there's a UDI or something like that. I think that's what that is. There's a tax. In these situations where you're talking about, partnering with the trust and, um, building something larger, are there any tax concerns there from a strategy?
No, we don't have those regulations or those rules like the 401ks or the IRAs.
Okay, that's great. That's great. So let me ask you this. So the ideal client, you've mentioned obviously the people that, either had 10 million or the school teacher that went from, 200,000 to 1.4 million. I mean, um, sizable chunk. What about the person that's owned just a single family, rental home for a number of years? It's appreciated. They get out, but it's not, change your life money. It's just something you don't want to let go of the you don't want to pay the tax on it because
Yeah.
you've held it long enough that you've depreciated it and you've,
Mm-hmm.
recapture all that fun stuff.
Got it. So our minimum deal is $1 million net proceeds and $1 million gain. Why? Because we found that unless the pain is big enough, which means the gain needs to be big enough, which means the tax will be big enough to justify our fees, then it doesn't make sense. So we want it to be a home run for everybody involved. And we found that unless it's $1 million gain and at least $1 million net proceeds for any single transaction, doesn't make any sense. Okay. So if you just have that $300,000 house, you bought for 50 and you're like, man, I don't want to pay the 50 or 60,000. Sorry, it's too small for us. It's just not a great deal for anybody because the fees will eat up the savings. What are the fees? About 1.5% to set it up, and about 1.5% or so, depending to 1.85%, depending on the size of the deal. So you want to make sure that your that it's big enough. Okay. Now, if you had two deals, if you go, well, Brett, I got two deals of 500, 500. Yeah, we can make an exception for that. But otherwise, the answer is no. It's got to be those two numbers. Does that make sense, Darren?
Yeah, exactly. That's exactly what I was getting at. I was going to ask you. I can't read my writing there. If it comes back to me, I'll ask you here. But so basically, the sum of it is if you've got a sizable chunk, and you're looking for an alternative to paying the tax, this is a way to do that without having to get into another deal at the top of the market, and hope that it all works out. I mean, that's kind of what I'm
Yeah.
hearing, and
Say
it makes
eliminate the need for the 1031 exchange forever,
right,
right? And
right,
never have to feel like you're trapped to overpay. So the 1031 is used to defer tax. The deferred sales trust is used to give you back time, right? To lower your stress, to let you be location financially, business freedom, right? Freedom on a number of levels, not just capital gains tax freedom. So, yep, that's exactly right, Darren. I think you got a good grasp on it.
Oh, and let me ask you this, 'cause this is what I was thinking about. So, as far as the management of the asset of the trust, is that unique to your company, or is that something I can go to my broker and say, hey, I want to do a deferred sales trust, set me
Great
up, or
question. So we partner with financial advisors across the nation. So we have thousands of strategic alliances, including commercial real estate brokers, luxury realtors, financial advisors. And so it's very important that the order of this makes sense. So if you have a financial advisor, if you're a financial advisor, reach out to us, sign our NDAs, get connected, right? Get it all approved, and then bring it. You can bring it to your clients, right? That's just fine. So that would be the order you want to do that, Darren. So if have the financial advisor contact us and get connected with us.
got it. All right. Hey, Brett, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk.
Mm-hmm.
And there's three strategies we typically look to. We first look to see if we can avoid the risk. If we can't do that, then we look to see if there's a way we can minimize the risk. And when avoidance and the ability to minimize the risk are not an option, then we look to see if we can transfer the risk. And that's what an insurance policy is. And I like to ask my guests if they can look at their own situation. It could be their clients, the market, investors, tenants, however you want to frame the question. But if they can identify what they consider to be the biggest risk, and for clarification, I'm not looking for an insurance-related answer per se. Risk is everywhere you look. But if you're willing, I'd like to ask you, Brett Swartz, what is the biggest risk?
Sure. So I'm going to apply it to the deferred sales trust because we didn't actually touch on this, but I think this is really important. So it has to do with asset protection, right? So the more you own, and the more you own in your own name, and or that's not in an LLC or that doesn't have proper insurance, the more you could be liable and have higher risk of somebody suing you and taking that asset. Okay. So by essence, ownership, and Rockefeller said it well. He said, own nothing, control everything, right? And the idea was asset protection. So how do you lower risk? Well, with the deferred sales trust, guess what? You become the lender. You don't own the trust. So what you don't own, they can't take from you, right? By default. Now, could a creditor, if they get a judgment against you, and could they potentially get the income off of the trust? Yeah, that's common, right? But could they force the ownership that's not the person that they got the judgment against to do anything there? No, because they don't own it. So we do love that about the deferred sales trust too. It does take and mitigate some of the risk. So I think part of the answer is the risk of just lots of ownership in structures or that are not insured in a proper way, that could be subject to judgments. If there's a way to mitigate that, I think that's really good. And I think that's probably the biggest risk I can think for this conversation here. Does that make sense, Darren?
No, absolutely. That whole eliminate your risk by have no assets or, but control it all. That's always a great way to view things.
Yeah, it's no longer about cash flow, Darren. Cash flow is important. See, Robert Kiyosaki talked to us about cash flow, right? It's now about tax flow.
Right.
Okay.
Right.
And especially for the ultra wealthy who have baby boomers who have made it, right? And now it's preservation. It's not necessarily creation, at least not in this marketplace. We're more like, we'll take a more conservative preservation. That's our philosophy. And let's focus on tax flow, because guess what? Taxes are going up, right? Taxes are going up. So what do? Well, let's get into the deferred sales trust. Let's delay the income. Let's delay the capital gains tax, right? Let's defer it. Let's move it outside of the taxable estate. Let's move it outside of the potential risk of judgments of ownership. And then let's sit in a safe harbor, diversified, liquid, ready to go if and when the market shifts. And then you get aggressive again, and then you take on more debt, right? So it's about smart debt versus dumb debt, right? Dumb debt doubles down and overpays for our property because they got to run around with their hair on fire buying a 1031. Smart debt buys when the marketplaces crash, when everyone's running for the sidelines and doesn't want to buy anything, right? And then the deals are now you go into debt. Now you leverage up. So that's kind of the thought, if that makes sense, Darren.
No, always makes sense. It's always one of those things that's easier to see in the rearview mirror rather than looking forward. But that's still, it's a matter of just preservation. If you're getting out at a good number and you're not ready to do something, I don't want to feel pressured. I think it makes a lot of sense to be a little more disciplined about it. So great. Hey, Brett, where can the listeners go if they'd like to learn more or connect with you?
Thanks, Darren. They can go to capitalgainstaxsolutions.com. They can search that on YouTube as well, and they can search it on iTunes. We have a podcast YouTube channel that's growing rapidly. We have guests like Darren on all the time to talk about all the things we're talking about here and more. So that's capitalgainstaxsolutions.com. We also have a free ebook for you, Sell Your Real Estate or Business Smarter or Cryptocurrency Smarter. You can download that. And the last thing I'll leave for listeners, if you're a business professional, luxury realtor, business broker, financial advisor, commercial real estate broker, syndicator, insurance professional, you can go to experttaxsecrets.com. That's experttaxsecrets.com. And you can learn how to use the Deferred Sales Trust to grow your business.
Awesome. Well, Brett, I can't say thanks enough for taking the time to talk today. I've enjoyed our talk and learned a lot, and I look forward to doing it again soon.
Thanks, Darren. My pleasure.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.